Hey folks, welcome to another Google Options update, and I have some good news this time. The stock ended last week at 101, which is quite a bit higher than the previous week, and along with the $188 in option premiums I made, the end result is I'm up $2,000, so that's really good to see, and I am back to being profitable. Not a lot, just $500, but it's good to be above the $0 line. I'm actually more excited about this week because I think there is potential to earn more than $2,000. And the reason is because it's earnings week for Alphabet, and that means implied volatility is high, so the premiums will be high as well. Last time it was week 2, we had the previous earnings, and you can see implied volatility was at 74%. Whereas normally Alphabet is in the 40% range or so. And as long as I control my risk, I should be able to make a lot of premiums. So last Friday, the stock ended right here at the top of this green candle, which is very much in between my 106 call and 95 put. So both of these expired worthless. But what about this week? I normally sell my Google options on a Monday, but because it's earnings week, I wanted to wait until today, right before the earnings come out. After the markets close today, Alphabet will release their financial report. The closer you can get to before they release the report to sell options, the more money you can make from the premiums. So for example, on Friday, where this green bar is, I was taking a look at the implied volatility for Alphabet, and it was at 59%. This was on a Friday. And then on Monday this week, which was yesterday, the IV jumped up to 74.6. And then we jump to today, and the option chain in real time looks like this. We're at 81% implied volatility. So that's why I waited until now to do the options instead of doing it yesterday, because the higher the IV when you sell the option, the more money you make. Okay, so in terms of this week, where do I think Alphabet can go? In terms of where I want to set my calls and my puts, I'm going to have a pretty wide spread today. So for the call, if I make a trend that is going up this way, I'm basically creating a channel that encompasses all of the previous couple weeks of price action. So Friday is this blue dotted line. We could end the week at 112, let's say 113, if earnings are really good and the stock just rips. So this would be 113. I might have to adjust this a little bit because I also want to take a look at the weeklies. In terms of the put option, well, I have to go back to pretty much the beginning of 2021. So I might have to go down to like around the $90 level is where I think the last support is. So there's a support here at 92, and then there's stronger support here at 90. Okay, so that's a pretty wide range there that I think is pretty safe. But let's take a look at the weekly chart. So each bar now represents 1 week. And what I did this morning was go through the chart and look at any weekly movements that was fairly big. For example, this red bar over here. And then I measured how much of a move that entire candle represents. So if I use this measuring stick and I put the top basically to where the top of the wick is, and then I move the bottom to the bottom of this lower wick, and I move this on top of the weekly candle, you can see this tells me that that is a negative 9% move. So during this week, the stock moved down 9% if you measure it from the top to the bottom. So I went back and did this for the last 10 years of Alphabet, and it seems like the biggest weekly move, if you measure it from the top to bottom, is around 15%. In order to be safe, I think it's a good idea to use that same kind of 15% move in order to place my call and my puts. So if I get rid of this channel for a second, just move this over so we can see what's going on over here. This is the current week right here, earnings week. And in order to find my call strike price, I'm going to put the stick, the bottom of it, at the base of the bottom wick of the candle. And then the top, if I move this to 15%, this kind of tells me where the upper range would be. So if I move this up here to, this looks like it's going to be about 115. I think that is a safer call. You always want to be careful with call options or call spreads because you can lose a lot of money on the upside. Whereas there's a certain price where Google Google will stop falling. Maybe that's $90, maybe that's $80. I don't know. I think last time I said around the mid 80s is where I think Google can reasonably fall to given its financial strength. But that doesn't mean we won't see a temporary dip below that level if the market happens to be very fearful. Okay, so that's 115 on the upside. And then on the downside with my put, we're looking at about like $88 or $89. But I don't think I'm going to make a lot of premiums down there. So I'll probably keep my put at 90. So this is one of the largest spreads that I've ever made. And that's like a $25 difference between my call and my put. And the reason I want them to be so wide is because it is earnings week, which means the expected price fluctuation of the stock is massive. And I don't want to be caught off guard by that. So I'll jump back into the daily chart, and this is pretty much what it's going to look like. There's about 57 minutes of trading left, so I'll just put in the trade now. Maybe I can get the IV a little bit higher by the end of the day, but I think like it's not going to be much of a difference. Most of the IV increase has already happened. Let's do the put first. If I go to 90, I can see there's a 19 cents with a 5 delta. That's pretty good. So usually what I do is I sell some puts and I sell some calls. But because I want to take advantage of the higher IV, I'm going to be selling spreads today, which basically means I'm going to be adding protection on the downside. So for example, if I sell the 90 put, I'm going to go to the maybe $88 put and buy that one. So instead of making $18, I'm going to be making $18 minus around $12. So that's like $6 for one pair of contracts. And if I go down here, you can see the margin impact is very small, and it looks like I can make about 7 cents there. So I'm going to be doing two trades, both of them vertical spreads. So I'll do a vertical put spread and a vertical call spread. It's basically an iron condor, what I'm doing this week, but I'm splitting the IC in two. So I have a put spread and a call spread separately. And the reason I'm doing this is so the trades can fill faster. They don't have to wait for the other legs to be appropriately priced to get filled. So I'll do the put spread first. And the important thing is to just make sure I have an even amount of contracts for both of these trades. So for my quantity, I'm going to go with maybe 25 and I'll see what that looks like. Okay, so I'll make $137 roughly with this spread. If I look at the profile, this is what the put spread looks like. There's a 97% chance, so very high chance that I'm going to make $125, but I have to keep in mind of the maximum loss here. I could lose up to about $4,900 if things go really, really bad. Now, I will probably get out of the position if Alphabet drops a lot. So this maximum loss, it's just theoretical. It won't actually happen because I can close my position. I can roll it forward to the following week. There's different things I can do. But if I don't do anything, then there is a potential if Alphabet falls to below $88 per share, that I could be losing thousands of dollars. So I have to basically watch this throughout the week. Okay, it looks like I can make 7 cents roughly. Maybe it'll be like 6 cents by the time this fills. But I'll submit order. And I'm going with 25 contracts because getting close to the maximum amount of margin I can use, because I have $20,000 and I've used most of it buying the 300 shares that I already have. Okay, so that order has been put in and the mid price is now lowered to 6. So I'll drop it down to 6. Let's see if it fills.
Order partially filled.
Okay, so 3 out of 25 filled. I'm still waiting for the other 22. But in the meantime, I'm going to go ahead and put in the other trade for my call. So I mentioned 115 would be the highest that I think Alphabet can go to by the end of this week. So that's right here. And it looks like the premiums are better here. So 115, I will sell the call option, and then I will buy the 117 call option. And that'll be a spread of about $12 or $13. Okay, so 12, 25. So that would be about $260. Submit that.
Order partially filled. Order filled.
All right, the bull put spread has been filled. That was the first trade I put in. The bear call spread,
Order partially
only
filled.
5. Oh, it's going through now.
Order partially filled.
19 out of 25 have been filled.
Order filled.
And there we go. The last of those contracts are now filled at the $12 price. And this one's at $6. A lot of commissions for these, as you can see. If you add up the put and the call spreads together, that's about $90 just in commission alone. Let's take a look at what that looks like in the portfolio. It's basically these two right here. And the reason I have an unrealized loss right now is because this factors in the commissions. So even though the options are worth the same, I am currently taking a loss because I paid a lot of money for a commission. If I open them, so selling the 115 call, buying the 117, that's a bear call. And then the bull put is sort of the opposite. And then the last thing I want to do here, again, just to take advantage of the higher IV, I'm going to be selling covered calls on the 300 shares of Alphabet that I have, but I'm going to choose a very out of the money strike price. So I'll go to like 118 here, which has a delta of roughly 5, and I will sell this and I'll make $13 or $14. That's the bid and the ask. Let's go with 14 for now. And for the quantity, I'm going to go with 3 because that's how many lots of Alphabet I have. So it's not going to cost a lot of margin for this because I own those shares. So that's why these calls are covered. But I can make about $40 doing this. And if they get called away at 118, then I'm perfectly fine with that because my average cost is 107. I have 300 shares. My profit would be over $3,000 if that happened. And it hasn't filled yet, so I'm going to drop this down to 13, which is the bid. It's just $1 less, but this will make sure it gets filled.
Order filled.
Okay, so all three got filled at 13 with a commission of $3, so that's about $12 per contract. Not a lot, but it just adds a little bit more premium for this week, which I think should be over $400, which is double what I usually get. So the implied volatility is 82 right now. I'm going to fill in my premiums by the end of this week. Yeah, otherwise, that's it for this week's update. It's nice to be back in the black. By the time you watch this video, Alphabet earnings will be out already. So take a look at the stock and you'll know if my option trades this week are well positioned or if I'm going to lose a lot of money. Either way, good luck out there and I'll talk to you in the next one.